Hello, everybody. My name is Ty Bernicke, and I will be doing your monthly market update for July 2024. And for this month's market update, I wanted to talk a little bit about some of the different indices that the mainstream media uses to talk about the performance of the stock market. Sometimes they'll talk about the Dow Jones Industrial Average, also known as the Dow, to reference how the stock market's performing. Sometimes they'll reference the S&P 500 index, and other times they'll reference the Nasdaq. Now, there are several different characteristics that differentiate these different indices from one another. One notable characteristic is the percentage of stocks held in the technology sector of the stock market. As you can see, the Dow Jones Industrial Average has about 29% of its total capitalization into technology stocks. The S&P 500 index has about 35.8%, and the Nasdaq has a whopping 55%. So naturally, in times where technology stocks are doing well, it's going to help the Nasdaq much more than the Dow Jones Industrial Average. And these percentages do vary from time to time, but for over the last 20 years, it's been relatively static from the perspective that the highest concentration of technology stocks tends to reside in the Nasdaq, and the Dow tends to have the smallest amount, and the S&P 500 index usually falls in between those two. And so I think this is worth mentioning right now because technology stocks have been doing very well the last year and a half. And when that happens, a lot of people tend to migrate their investments towards funds that tend to be very laden with technology stocks. And a lot of times they do it unknowingly because they gravitate to whatever has performed the best, not knowing that they might be putting a big portion of their portfolio into something that's very concentrated in one sector of the stock market. Now, the last time that I can remember this outperformance being so sizable with certain large company technology stocks was back in the late 90s and early 2000s. And there was a big run up where technology stocks performed great, but then the stock market crashed. And the category that crashed the hardest, or the sector that crashed the hardest during that time, was technology stocks. And if you look at this graph, you can see that this yellow line represents how the Nasdaq crashed starting in the latter part of 2000 into 01 and into 02. And it took many, many, many years before it even got back to where it was in June of 2000. However, the Dow, as measured by the purple line, you can see it definitely took a hit during that downturn in 2000 and 2001 and 2002, but it didn't take nearly as long to fully recover from where it had been previously. And the S&P 500 was somewhere in between the two. So again, I think this is relevant now for a few different reasons. Number one, when people are looking at their 401k plans at work and their other retirement accounts, make sure that you're diversified between a lot of different sectors of the stock market, or you might be unknowingly stepping into a landmine if and when the stock market crashes, because a lot of times whatever went up the most before the stock market crash tends to be the sector that goes down the most when the crash actually occurs. And number two, just make sure you've got your eggs spread out into a lot of different baskets. There are a number of different ways to look internally at the funds that you have to determine what percentage of your portfolio is invested into technology stocks. So if you do have any questions, please give us a call, give one of our advisors a call. We'd love to help you out in any way we can. Otherwise, I hope this sheds some light on some of the different measuring sticks that are used to gauge how the stock market is performing, and also helps highlight some of the things you can do to put the odds in your favor for reducing unnecessary risk and having a successful retirement. Thank you.